Hey guys, thanks for joining me in this video. In this one, I'll be talking about money market funds. If you're new to my channel, my name is Stephen Ojo, and on this channel we talk about aviation and finance. And if you're interested in any of those, kindly subscribe to the channel. And also, if you find value in this video, please give it a thumbs up. I would really appreciate it. Now, the purpose of this video is to talk about money market funds, like I already mentioned, but not to be confused with money market accounts. These two are different, and I'm just going to highlight a few differences. Like money market funds are generally offered by brokerage firms like Vanguard, Fidelity, TD Ameritrade, and so on. Whereas money market accounts are generally offered by banks and credit unions. The reason why I'm talking about money market funds for today is because I'll be able to answer a few questions as we discuss the subject. Next, I'll be talking about the different types of money market funds that are out there, and I'll actually show you some examples of the ones that I come across and just highlight the differences from each other. Then we'll move on to taxable money market funds and how it differs from the tax-exempt money market funds, and how you can use these two to save yourself some money, and of course use them to maximize your gains as well. So with all of that said, let's jump into the video. Now, a money market fund is pretty much a fund that has been created by, say, a brokerage firm, and the goal of this fund is basically to invest the money that you put into this fund, to invest that money with government securities, or to invest that money in companies. Think about it like bonds. So the whole idea of you putting your money into a money market fund is that that money is invested in safe securities, and they're almost guaranteed to always return something to you. However, because they are so safe, that also means that their returns are always very low. But generally, they return better than savings accounts. So if you're looking for a place to put your money, instead of putting a savings account like, with banks that pay 0.01% in interest rates, you can put your money in a money market fund. So this money will be invested with, companies, the government, and this money will be loaned out to this company. Within a short period of time, they will be returned to your account, and you will collect coupons or dividends from this. Now, one of the benefits of investing in money market accounts is that because they're so safe and they carry almost no risk, although there's still a bit of risk of default, but it's very minimal, you tend to keep up with inflation because of the returns you make on this money, compared to what you put in a savings account in a bank that returns very, very little. So you probably are losing money to inflation by putting money into a savings account. Whereas with money market funds, your money is able to keep up with some inflation, and sometimes it could beat inflation as well. But that is always not the case. The best I can always say, and I've always seen, is that they keep up with inflation. So if you're planning to invest for a short term, say maybe 6 months to a year, maybe to 2 years, for something that you particularly need or you want to acquire at a particular time, then it is always best to put your money into a money market fund. One of the things you always want to consider before putting your money into some form of account or a fund is, are there expenses that comes with it, or are there limitations? For example, with the money market accounts that you get from banks and credit unions, you generally have a limited amount of transactions that you can make on those accounts. That's why they're called an account. Whereas with the funds, you generally don't have any limitation, although you would have what they call an expense ratio, which is generally very, very low, which is why you're not always too concerned about the expense ratio, but it's always a good thing to keep in mind, because there's always a bit of an expense involved to get that fund running. Now, there are different types of money market funds that invest in various, securities. Some would invest with the government, some would invest with companies, some would have a mix of the two. And while some will actually be invested in certificate of deposits and treasuries from the government and so on, or even municipal funds as well. So the point of this money market fund is to seek what suits you. Some of them are taxable, while some of them are non-taxable. Like I said, I'll be talking about those two in particular, the tax related ones, at the end of this video. So let's look at a few ones that I've come across, some from Fidelity and some from Vanguard. Let's see how they differ and what makes them unique. Now on my screen right now, I do have one from Fidelity, and the name of this fund is the Fidelity Money Market Fund with the ticker SPRXX. It says your product type is retail. And that is because as we look under the fund here, it says about 39% of it is invested in financial company, commercial paper type of asset. And down here, it tells us that the advisor invests the fund assets in US dollar dominated money market securities of domestic and foreign issuers. This has an expense ratio of 0.42. The second one is the money market taxable government fund. Okay, this has the product type. It says here government, and it's the SPAXX. As we can look down these numbers here, you can see that it says this only invests in government-related, securities, U.S. Treasury bill, agency floating rate securities, U.S. government repurchase agreements. So mostly the money is invested with government-related securities. And it says here the advisor normally invests at least 99.5% of the fund's total in cash, U.S. government securities, and all repurchase agreements that are collateralized. So the expense ratio on this one is about 0.42% as well, which is similar to the prime money market fund as well. But remember, this is taxable. So again, when you add that to it, it tends to reduce your gain a little bit. Now, the third one that I have here is actually a tax-free money market fund. And again, the expense ratio of this one is 0.42 as well. But as we noticed, this one is invested in municipal notes, municipal bonds, tender bonds, and commercial paper, variable rates demand notes. So these are pretty much government-related securities as well, but they are tax exempt, okay? Which means that, if you're looking for a place to put your money and avoid paying taxes on it while it builds or accrues in gains, you can put your money in this type of funds. Of course, they are usually very low paying as well because they're safe and you don't have to pay taxes on them. So the government obviously won't pay as much interest on this type of securities, but they are always useful for people that have made a lot of money, maybe in a type of investment, and they want to put that money there temporarily until they decide what to do. Because remember, you've made the money from a type of investment in the first place. You don't want to bring that money knowing that you're going to pay taxes on the gains, and then you don't want to bring it into another taxable type of investment, because that means you'll be paying taxes in two places. So the best thing you can do is always to hold it in this type of investment until you decide what you want to do with that money, and then you move that money away from this type of fund. So like I've showed you guys 3 from Fidelity, but I'm just going to go show you 1 from Vanguard. There's a lot from Vanguard as well. There are tax exempt ones from Vanguard as well, but I'm just going to show you 1 in particular from Vanguard, which is the Vanguard Federal Money Market Fund. This one in particular is a government, type of fund that invests in government securities, has a minimum investment of $3,000. But here's what is interesting about this one. If you look at the performance of this one in the past 3 years, it's about 1.3, and then in 5 years about 1.8, and then in 10 years about 0.5, and then in the lifetime since 1981, it's returned about 4 something percent, which is not bad, knowing that this is a very safe type of investment that you can put your money in temporarily. Of course, like I said, you don't want to put your money in this type of investment for too long. It's just a temporary place to park your money and then use it for what you have saved it up for. The reason why I'm showing you this one in particular is the expense ratio. Look at the expense ratio in this one. This one is about 0.11% compared to the ones that we've seen from Fidelity. Now, obviously, if you're looking for a place to invest your money with a very low expense ratio, then Vanguard is a place to go because, again, they have a very low expense ratio and they have a good performance as well. Now, I hope that you have found some value from this discussion of money market funds and how you can use them and why you should probably have some money saved in money market funds, because at the end of the day, you want to put your money in a place that will at least keep up with inflation. Of course, interest rates are so low right now, but when interest rates go up, these funds also pay well as well because they will keep up with the interest rates at the time. Well, I hope that you found value in this one, and I hope that you've given this video a thumbs up. If you haven't subscribed yet, please subscribe to the channel, and I would love to see you in my next one.